Lately, every conversation about investing seems to start and end with AI. Nvidia, AMD, the entire semiconductor hype cycle. But while everyone is chasing the next algorithm, a lot of great businesses are just, well, being ignored. Take Nike stock, for example. It's not flashy, it's not new, but this is still one of the strongest consumer brands on the planet. Revenue steady, margins are healthy, and yet investors' attention practically gone. When markets get noisy, it's often the quiet names that offer the best entry points. So today, instead of talking about chips or cloud computing, we're going back to something simple: a global business with real cash flow and long term staying power. Let's break down whether Nike stock deserves a spot on your radar again. Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And as I mentioned, today we're gonna go over something not as flashy, but you might heard of it. We're gonna talk about Nike stock and whether it's a good buy or maybe something to keep your eyes peeled. In the meantime, while the whole planet is going bananas over AI hype, basically. So, Kirill, what's in the news?
Yeah, I got the cringy joke. That's the only thing I got for the news. Is it a good buy or is it a good buy?
Oh, okay.
Yeah. Sorry.
Yeah.
I feel bad now. Yeah.
All right, but
Um.
normally we would go over what's in the news, the company fundamentals, and of course the value you're gonna get out of this video. The valuation of Nike. This will be the starting point of your own due diligence. So, yeah, don't take this video for granted. Whatever the outcome may be, do your own research. This is not financial advice, for entertainment and educational purposes only. Kirill, shall we then dive into Nike straight away into the fundamentals of the company?
Yeah, of course. Yeah. So I got our 930 app opened, and I think also one of the reasons why we thought maybe it's a good idea to look into Nike stock is just look at his graph. Look at the stock price. It's yeah. At least Robin appreciated the joke. Thanks. It's just going terribly bad. There are many reasons for it, of course, because of the operational troubles. It's also because of it's not an AI hype stock, as Robin mentioned in the beginning. So there's really no fuel for the stock to actually grow at the moment. But maybe what is good about it is still there's a good value in the brand itself. They still have great operations. They still have more or less pretty good products, even though despite increasing competition from the new brands, from the existing brands, for example Adidas and the other bigger ones. It's still a big thing. And maybe it's really worth looking into it, looking into the fundamentals, looking into the valuation, of course, and maybe maybe it's something to pick up at this price point of $60 per share. Why not?
Yeah. Exactly. And also, if we can just quickly go over the news real quick.
Yes.
Just you see the drop and the rise in May, June on the right of this year. And that was the announcement that Nike went back to Amazon because they completely neglected, no, of this year, Kirill, 2025. So you see the little bump there. So that was after the announcement that Nike started selling again on Amazon. They had some issues with their distribution and channels. That's when they went back to other marketplaces, let's say. So that's the bump. And now it declined again. And as Kirill mentioned, that was basically the one point of news that has ever been coming out of Nike since basically May, and it has been silent ever since. So let's take a look if they fixed their selling and general expenses, maybe if everything's back on track, how the revenues are going. Yeah, but first, Kirill, let's see if what is the 930 score of Nike?
It is actually B, surprisingly enough. But then again, it's about the performance for the past 20 years. And the worst parts are, of course, operating margin. That totally makes sense. It's a manufacturing company. The revenue growth also makes sense because, again, it's well established. It's a cash cow kind of company, so it's really hard for it to grow further. And the net income growth. So the top line and bottom line of the company already really mature. But for the rest, the return on invested capital is good. The stock price appreciation was also good. The PE, so it's pretty good deal you could get it for, and the gross margin is also quite nice. So, typical cash cow of a company.
Yeah, nice. So let's go into the fundamentals, the checklists, see if there's any to gain. So over the past 20 years, revenue growth check 6% per year on average for the past, on at least how much data we have. So that's quite impressive actually. Net income growth 13% on average. Free cash flow growth 25%. They have their long-term debt covered by the free cash flow, meaning that if they want to, they can pay off their debt, which is of course nice for you to know as an investor. So it's a hard ship to sink, basically, or difficult ship to sink. Average share buybacks, so they do not dilute you. Great to see. And they pay a dividend. So as Kirill mentioned, cash cow of a company, they are really into the shareholder value aspect of their business, making sure that they buying back shares and giving a dividend. Of course, what investors like to see. But let's go into the key financial ratios and see whether or not the financials actually allow them to do such things.
Yeah, I'm just also quickly scheming for any other abnormalities, let's say. And to be honest, don't really see anything too bad. So everything what we just discussed, don't really want to dive into details. Only maybe the good thing is that the COVID debt that they loaded up in 2019, they are gradually paying it down, which is nice. So they're already paying down 2 billion in debt.
It's so fun to see that they didn't really have a lot of debt, and then they were able to get free money basically, and they were like, yoink, let us get into that action. I mean, it's a good call, right? Now they are sitting on a pile of cash that they can pay off if they want to.
And that's exactly what you also see with the free cash flow per share outstanding. It's going quite fast ever since 2019. So that and that's how they probably can fuel their dividend growth. That's how they can fuel their share buybacks, which was also still consistent year over year ever since 2004. Just to be honest, really good thing to see. So from 2.1 billion shares, it's already at 1.5, which is crazy.
That's quick.
That's crazy. That's quick. Yeah.
That's crazy fast.
But going to the ratios.
The net earnings ratio on the low side.
Yeah.
Wouldn't expect it though.
No, but that's exactly what the 930 score was saying, right? So their bottom line is suffered, again, just because of the fact that the revenue is suffering as well. So it's totally, it makes sense. It's like a Coca-Cola kind of company, but instead of saying selling soft drink, it does shoes and clothes and stuff like that.
Yeah, of course, but their margins are so slim. Probably also because of the competition.
Yeah,
people want cheaper stuff. So
exactly.
That could be the case.
And we can also actually
funny to see, because you would think that they would write a lot on their brand.
Yes. I fully agree. The thing is, we can see the gross margins are slightly going down. So from average of 45% to 41% the most recent year. But the operating ones are going
stable
down.
Though, to be honest, right?
Yeah. So what probably means is that the prices they are charging are quite high still. The cost of production are probably going higher. Mm-hmm. And because of the fact that they're still charging quite a lot to the customers, the revenue doesn't really grow that much, because if I see $100 or $200 Nike shoes, and if I have alternative for half of the price, I'm probably gonna switch. If you're not such a loyal to the brand person.
Correctly. I also think they need to. There's a lot of hype around in this community about some of the shoes, but it would be good for them to have some really high-profile releases. For example, I think the competition such as New Balance does it really well, where they have a shoe and everyone is wearing them. I've not seen Nike has a really consistent base when it comes to shoes. Like you always see the Air Force Ones or the Jordans or whatever, but not a lot of new stuff. But maybe that's good. I mean, it works. But
yeah, indeed. And then there's Lululemon, for example, for the, let's say, the fitness apparel. There's also upcoming brands in the running shoes, for example. So there's small competitors popping up everywhere, and it's really hard to shield your castle, your moat from them, from these kind of attacks. So
all right, Kirill. What do you say? Let's go into the valuation, where everyone's here for.
Yeah.
So for the valuation, if you're a first-time watcher, first of all, welcome. And second of all, we will guide you through our valuation method. So basically, we have made this application where you can plug in your numbers, your assumption, in order to derive to a valuation of any company that you want, basically. So we already give you some pointers. So for example, you can choose the average revenue growth of 3, 5, or maximum amount of years we have, whatever suits your valuation and also your investing style. For Nike, I think either 3 or 5 years would be a correct representation of their business. So yeah, let's start with the free cash flow starting point. We always do last year, but again, if you want to do something else, you can play around with this. Sometimes if you have some negative cash flow, this might be a bit iffy. So that's how you can solve it, basically. The projection period, Kirill. How about a longer period of time? I mean, Nike has been around since forever. It's a primary need of the human civilization. I don't think it's going to go anywhere anytime soon. I mean, not Nike specifically, but they make clothing, basically. And also their growth estimates are really not that high.
You know what we can do? Maybe you can check out what the analysts are saying, and in the meantime, maybe I can just speculate a little bit on this topic. So basically what we have at the moment is a cash cow of a company, which is not growing anymore. And what can actually, I wouldn't be surprised if we're gonna have a reduction in the revenue. Let's say in a 10-year time, and they're really gonna suffer a lot. If some other competitors are really gonna pick up on the price, especially at the price points where they can actually provide more discounts, or they can provide more affordable products, but the same quality, So what I would maybe say what we can do is we can do two scenarios. One is where we, let's say, put no more than 5 years with more or less minimal growth options. So let's say maybe a couple of percent, but then also let's check what Robin will find out. And then if we want to do more years, so let's say 15 years, I would rather check, let's say, what it will look like with 0% growth rate.
Okay. Yeah, so our friends at Yahoo Finance, they do their the way they get to the analysis is so fun. I would want to go to their office one day and just check what they are doing, because it's so bananas. So they're saying, okay, the growth of Nike for the next quarter is going to be minus 12%, the current year minus 23%, but next year 50%. What else? It doesn't matter. It's just going to go sky high. Everything's going to be rainbows and sunshine compared to, for example, 13% growth for S&P. So, yeah.
That's also probably one of the reasons why we made 930, because whenever you see these kind of terrible things on very well established Yahoo Finance or any other portals, you're like, yeah, where the hell do you get that from? Because this is just unreal, So, this is, guys, how you can bridge that gap. Simple.
Well, so let's say if we would assume, if we add up the average growth for revenue and free cash flow for the past 3 years, so that is 5%, right?
Yeah.
So 2.5% growth.
Let's give it 3%.
Yeah.
Let's say if there's inflation, if they're still alive, still afloat, everything is fine. And then they can just be maybe on par with inflation, maybe a little bit higher, whatever.
Also, we forgot the discount rate, but we always keep this at 10%. But feel free to do your own research about the discount rate and what it does to the formulas. And then you can do whatever you prefer. For the projection PE ratio, Kirill, 26 PE ratio.
That's also quite a lot. I mean, for the company that is not growing, to me it's too much.
Maybe we can hover towards the low estimates of the past 3 years, so the 20.
Yeah.
The required rate of return, if you're stock picking, you would expect a higher rate of return because you have a bit more risk, right? Take, for example, the S&P, what we just said, it would return this year 10%, but because you're stock picking, you want a bit more. So either somewhere between 10 and 12% is what you would aim at. Of course, you can also do it a lot more. If you have a penny stock that has a lot of risk and you want to have a lot of return, you can do 50 to 100%, whatever you want. And the margin of safety, Kirill, this is based, of course, on how much knowledge you have about the industry and also how much risk tolerance you have. This is going to be higher if you're an older individual, but it's going to be lower if you're younger because you have a bit more time to recoup any losses. And then it's a question on how much or how well do you know the industry or the company. I don't think Nike is that difficult of a company to understand. They make shoes, they make clothes, they have stores, that's it. So I would even, put 10% here.
Sure. Fully agree.
And then Kirill, hit it.
Press the button. Oh, and we are talking about even $40 per share. And here's also the fun part. You can see while we, all the time, when we were checking the tech stocks, we could see how terribly off the valuations were for the Warren Buffett's rule of thumb formula and for Ben Graham's formula. But now it's actually more or less expected, especially considering the low growth rates that we're putting in and the fact that the company is having some troubles with the bottom line and with the top line. This is rather realistic, at least in my opinion. So if you would be thinking to pick it up, around $40 per share with a little bit of margin of safety, maybe we're talking about 35. Yeah. But what we can, go ahead, Robert.
No, just quickly, even if you would discount the fact that maybe Warren Buffett or Benjamin Graham or discount cash flow formula are a bit too conservative for you, if you would even go for the targeted valuation formula or the intrinsic value formula, you would come around fair value, and that's not considering any type of margin of safety, but that would be around $54 if you would incorporate that. So that would be good. But as Kirill mentioned, for these kind of companies, you can see that the Warren Buffett rule of thumb formula actually do make sense for the more cash cow, less growing companies.
Yeah. And also, just to run an experiment, if we, for example, put 10 years of projection period and see the difference, we get a bump of more or less $5 from the worst case scenario of the valuation, and then it's going to be around, I think, about the current prices, as Robin said. So the only trouble with this stock, guys, is that it's really cyclical. So what we're talking about, if the economy is doing well, if people have more disposable income, then they would be more than happy to buy additional clothes, additional smartphones, whatever. But if it's not a basic necessity kind of product, or a company doesn't offer these kind of things, then you would probably have these kind of situations that Nike is experiencing. They're in big trouble. So then the only thing is it would be only a question of when are we going to have the better economic situation and in what time frame it's going to appear. That's, I think, what I would like to highlight when it gets to this one.
And it might then also be interesting that whenever the market collapses, to look again at Nike and see if it's any good to pick up at that point. And then knowing that if times will go better again and people have more disposable income, they might go back to Nike again. Yeah. All right, Kirill, but there's always one more question on my mind.
What is it?
Where can we get this app, Kirill?
Oh, it's a very good question. I love your questions, especially at the end of the videos, yeah?
Always.
So we go to 930.com, as I always say, of course. The link would be in the description, of course. So you saw it. We offer 20 years of financial data. We have the valuation tool. We have the watch list. We also have a screener at your disposal. A bunch of different cool things with all the explanations, whatever you want, so you can make sure that you can do your valuations in any way that you would like. We are currently offering free demo. You can just click on the button, just have a look. You don't need to pay or anything. If you want to try it, you can sign up for free. And if you, of course, would like to actually purchase it, we are having 2 tiers for the product at the moment. We're also gonna provide a new update, and we're also gonna change the pricing. So we're gonna bump up our prices. So make sure that you lock your price at the moment, and you're gonna keep it even when the prices are gonna go up. So 930.com, link gonna be in the description. So hopefully to see you guys around.
Exactly. And with that said, thank you, Kirill, for your insights. Thank you for watching. I'll see you guys in the next video.